and welcome back to Off the Record with ETX Capital. I'm Andrew Sachs, and I'm joined once again here in the studio in London by Tom Higgins. Hello, Tom.
Hi, Andrew. Nice to see you again.
Very nice to see you. And actually, we've had long discussions about this over the years, but it keeps evolving because it's a subject and a very key component of our industry, which needed to evolve and has kept doing so, and that is liquidity.
Oh, vital. It's the lifeblood of any brokerage.
It is
where they get the liquidity from.
It absolutely is, and it keeps changing. The way, even for B-book brokers, and B-book being a type of brokerage which executes its own trades on its own dealing desk via a aggregated price feed rather than sending the trades to a liquidity provider, even that is dependent on how liquidity is priced and distributed and which sources are referenced and so forth. It keeps changing all the time.
Absolutely, and if you look at the sort of A-book, B-book model, where A-book is fully traded in the market and B-book is warehoused entirely, most people are hybrid model now. So they will, if they only have a license for A-book, then they will only do A-book because that's all they can do. If they have a license to carry some risk themselves, they will tend to do a hybrid model. But it's quite complex how they manage that. And we've got a whole piece of software, Visual Edge, which helps them do that, because it's not just a matter of small traders go to the B-book and big traders go to the market, because small traders follow professionals and then end up effectively look like professionals because they're following what the professionals are doing. So because of that, the liquidity that you have coming in is really, really key.
That's right.
You also can't, as a broker, you can't just chuck every trade, every order out to your liquidity providers and hope they're going to take it, because they don't like toxic trading. They don't like certain sorts of trading. Some like small orders, some like large orders, some don't like high frequency trading. They don't want order after order after order. They want larger, slower orders. And it's a matter of getting the right LP to match your circumstances. You've also got to have a backup for your liquidity, because technology is technology and it fails sometimes. And so if you want to offer a service to your clients all the time, you've got to be able to cope with the fact that one of your LPs has gone down or has a problem or has decided to stop pricing. In cryptos, this is a particular problem. Some of them just stop pricing, so you need to have multiple sources. That's a different discussion, but crypto liquidity is a whole thing in its own right.
It certainly is.
We do cover that with our crypto switch product, but that's a separate thing. We're talking about FX liquidity primarily here, and it's changed a lot over the years, and it's gone from being lots of providers to fewer providers.
It has.
Back to lots, and then back to fewer again. So
yes, there was a time when there was only 3 or 4 in the. Not the tier 1 banks, that's about 6 or 7 of them, which control 70 or 80% of all global Forex order flow.
Yes.
And that's changing as well, but we'll definitely come to that.
Yes.
However, within our sector, the non-bank retail Forex trading industry, the prime of prime brokerages, which are brokers that take liquidity directly from the bank and then package it and then retail traders use it. Even that, it was down to 3 or 4 at one stage, the genuine ones. There was hardly any really in the market.
Yes, it got down and then it's increased again now.
Yes, it has done, yeah.
So we have a product called MatrixNet, which is a partnership with our liquidity providers to distribute their liquidity through our Matrix product.
Right.
And we've got about 12 MatrixNet customers. So there are more than there used to be. There's more coming up. And one reason for that is it's much easier to access technology to become a liquidity provider now than it was before. It was really, really expensive before.
Was.
It's now not nearly so expensive. So you can do this. You also can access, as you were talking about, you don't have to go to a bank.
No, you
non-bank liquidity.
That's now very popular, and it's understandable why. In my opinion, if you can go to XTX Markets or Citadel Securities as a brokerage or even as a proprietary trader or a small hedge fund or something like that, you can go to those companies and they will not tell you, we will last look all your orders, we will charge you, and we want your lawyer to put $100 million into an escrow account in case you default on your counterparty credit agreement, because they are banks, so they treat their risk management the same way as they would lending a mortgage or a loan or something to somebody. If you're a retail customer, want to buy a car, you want a £10,000 loan for a used car, they'll risk manage you and they'll make you escrow some of your capital, or they'll make you secure it on your house or something. The same goes for counterparty credit. They'll just say, oh well, Citibank told us 10 years ago that something like 65% of all over-the-counter retail derivatives companies are going to default by on their counterparty credit agreements. So therefore, we'll cover ourselves by making you put 100 million in an escrow account. Now, who's got 100 million? Not that many people. Not many big companies even have. So you can go to XTX Markets instead, which understands our industry, or Citadel. I'm not being specifically loyal to any of them. A non-bank market maker of sorts that came from our industry, who understands the electronic trading world well, won't do that to you, and will give you very efficient execution.
It's amazing. I mean, I was discussing with them the other day about their pricing, and they were saying that they can't just mark up the price from the banks. This was XTX.
Yeah.
They can't mark up the price from the banks because they offer tighter than the banks. So they have to have really advanced models to be able to how long they hold a position for before they cover it in the market. And it's normally in minutes or seconds, or maybe for some products 10 minutes, but it's a short period of time to be able to offer tighter spreads than they could get from all of the banks together. So they'll always tend to beat the banks. So if you look at an aggregator that's covering non-bank and banks, by far the majority of the business is going to the non-bank.
That's for sure. Well, that's now got to the point where that was starting to happen, and it got played down to a large extent. But now that's been the case for 2 years or so, enough time for a few years to go by, and then the market share figures to be disclosed for each year. So since 2018, in the middle of 2018, XTX Markets and Citadel Security and a couple of other non-banks are now in the top 10, with those two right at the top, ahead of even Citibank, which was number one for 17 years, until they started saying that everyone's going to all their core customers. This is terrible. All their core customer base, which has been providing them with all of their income for 17 years, they then turn on them and say you're likely to default. So therefore, we're going to put a memo out saying don't extend counterparty credit to OTC brokers. It took them off the top slot of market share and paved the way forward for very astute, urbane, sophisticated companies like that to come and take the top slot, because it's now there in black and white. Brokers prefer them.
Yeah, I mean, banks they've got a problem because they're a bank, they're regulated as a bank.
They are,
and therefore it's very, very heavy regulation on them.
Right.
Because they're doing all sorts of things that banks do. If you're not a bank, you've got much more flexibility to do other things.
You also don't have all those legacy systems.
No.
Banks have by nature, as you know, I worked for years as a software engineer and a network engineer in banks. And what you're doing, you're not allowed to redesign anything. Everything has to be built on top of what was already there. Otherwise, there's no continuity, and it's too much of a risk. The whole global financial market system can be affected by a system outage. So everything's built on old legacy technology, and all those single dealer platforms that exist in big banks like the BARX system and things that underpin these tier one markets are legacy technology to a large extent, whereas in the very modern, almost hardwareless world of the over-the-counter non-bank sector, you can be whatever you want because everything is hosted. There's no hardware dependency, and you can adapt very, very quickly and develop new systems and solutions very, very quickly.
It's a bit like if we go on to a completely different area, it's a bit like looking at space. NASA technology used to be based on really, really old things that have been proven, and you could only use it if you'd been into space. So the sort of technology in the shuttle was really, really old stuff. And what SpaceX has done is come along and said, it's okay to fail as long as you don't kill people.
That's right.
So we will send rockets up, they'll blow up, and we'll learn from it. We'll send another one, it'll blow up, we'll learn from it. And in a period of a year, we will do what NASA would take 10 years to do. They wouldn't have blown any up, but it's taken them 10 years to learn. So it's much more expensive actually to not blow stuff up. So that's why SpaceX has won the space race with the old way of doing things, and NASA has changed its opinion quite dramatically. And I think actually I get why you try, break, and use that method to develop stuff rather than just build on old stuff that's too slow. Banks are the same. They are terrified of changing it.
They are indeed, yes. And they will admit that. It's not a secret. Anyone who works on any of for companies like Accenture or Deutsche Bank or Price Waterhouse or Fujitsu, Siemens, all these outsourcing consultancies that work with the banks, they don't allow they send consultancies on site for projects. They're not allowed to go abroad. They're not allowed to take the laptops out. There's lots of constraints because they're terrified of of using other people's networks and systems and of being outside the actual framework of a legacy system. You know, but going back to the early 90s, we were using IBM middleware systems inside the banks, and you weren't allowed, if you disconnected one of those 10-base-2 connectors from the Ethernet and took it home, they would fire their employees for that because they're connecting it to the World Wide Web instead of the internal system. And still, that mentality still prevails now. So you have a massive hardware dependency and a very frightened senior executives whose neck are on the line if there's a redundancy problem or something.
I remember when I went round, this was years ago, when IBM used to sell lots of hardware. Now they do less now, it's more software.
That's right, yeah.
And I went round one of their offices in South Bank, and they
yes.
showed me this open, it was a data centre.
You're talking about
glass.
the days of the Tivoli system. Yes, that's where that was based.
So it was all glass, so you could see through it. And I said to them, is this your computer museum? And they sort of looked a bit crestfallen and said, no, this is our bank software. This is the systems we sell to banks to demo the systems that they use. And I said, but it looks like it's 15, 20 years old. It is.
Probably is, yeah.
So no, it's sort of our museum and sort of our main sales area for banks.
Yeah, it makes sense.
But we probably ought to get back to liquidity because we had a go at the banks a bit too much.
I think so, and I think but it is kind of relevant because the way that liquidity is now looked at by a lot of good quality retail brokers is that you should be able to just plug it in with an API and switch it on and not have to have any of that last look hassle or expense of escrow accounts or constant wrangling on the, even a very short time ago, it was brokerages used to employ big burly guys to sit on the phone and argue with the bank about order flow.
Absolutely.
You don't really see that anymore.
No, and I mean most brokerages, because it's impossible to get a prime broker if you're a retail broker, you can't get one. So it's almost entirely prime of prime
It is.
prime of prime lookalike. So if you look at IS Prime, which is not really a prime of prime because it's off their own books, but it looks like a prime of prime. So
that's right.
To me, a prime of prime, really the model there is you deposit your funds with that entity and you get access to multiple liquidity sources, but it's all fronted by that one entity.
And those people are your friend.
Yes.
That's an interesting thing, and no one notices that. But those people who run those prime of prime brokerages are your friend. They're part of our industry and they're actually on our side. They're not arguing with you about taking which orders they're going to take and which they're going to reject, and you don't have to keep fighting over having a conflict of interest between a retail trader, the broker, and the trader who's executed a trade on the broker's platform, and then you have to go and argue it through the prime brokerage, who's then going to tell you no, and then they're going to make it an expensive business for you. So the prime of prime is sort of your friend. They're on your side, and they will execute either, as you say, either on a internalized risk managed basis, because some of them have their own risk management desk, and some of them have their own brokerage, which is a bigger liquidity pool.
Yes.
And then otherwise they'll send it to their market maker, which in some cases is a non-bank market maker or the bank.
Yeah, I mean, in fact, in the prime primes, it normally is. They'll normally have someone on the other side, which is a bank or a non-bank, and they'll have quite a few in there, and they'll have clever algorithms in their own systems to manage what they send out and how long a bit like XTX and Citadel and the other non-bank market makers do.
And this has now made it so that if you deal with these prime of prime companies that exist, it's a calm, good environment because they have these sophisticated systems which route their orders and aggregate price feeds to give the broker a good price feed, and then if a trade does go to the liquidity provider, it gets routed through these very clever algorithms to an execution venue that will take the trade.
Yeah, and what this means is that the retail broker who wants to access liquidity for their thousands of end clients, it's really easy for them. They just say, I'll pick these 6, I'll look at these, I'll pick 2 or 3 of them so that I've got some backup and I've got a good asset coverage. And off I go, and it's you plug it into Matrix, turn it on, and off it goes. And it's much more straightforward. I don't think they realise how they sound like an old person. How lucky they are that it's no longer complicated because it is just pick this, turn it on, pick this plug-in in, turn it on. Occasionally you get new entrants that need to be integrated, but most have been done now. Yeah. So you pick what you like and turn them on, and if you need if you have a different set of customers that need different liquidity, you can just add more in that to serve that need.
Yeah, I think so. I think that should be an area of growth, I think, because if you look at the way, and I've kind of been vocal about this over the years, brokerages are really and it doesn't matter because all of these primes are very good. All of them are very good. I mean, we've known them for years. We've worked with them for years. They're very good at what they do, and the industry is lucky to have such a what I call a middle tier.
Yeah.
It's a middle tier between the broker and the prime and the bank.
Yes.
That is so well designed and so well organised to the point where without it, there wouldn't be all this retail liquidity. However, everyone knows each other, and there are no new entrants to the market. So perhaps there should be other assets or other markets which are served by the same type of structure that could enter it.
Yeah, you're right. It is the same sort of people that go round and round and round. You don't really see that many new entrants come in. But maybe in other parts of the world you'll start seeing that. I'm always expecting China to start regulating FX and actually come into this industry. It's not happened yet.
No, it hasn't. But they'd have to do it outside because the yuan is not a free market. So the yuan is not it's a reserve currency, but which is astonishing. But it's not got it's got capital controls, and the bank is owned by the government, and they don't like anything being done internationally. So they'd have to be done with Chinese banks investing in places like Singapore.
Very much so.
And then you'd have the not necessarily PBOC, but the Chinese Industrial Bank or ICBC, some of those kinds of companies in Singapore where they can approach an international marketplace and use. I specifically pick out Singapore because that is a place where there is all the infrastructure, rather like London, for routing orders and for actually connecting trading venues to platforms. And Singapore has all that. So they'd have to invest in Chicago, London and Singapore, but through their own liquidity pools on an international basis, using major currencies. Yeah. They'd have to do it like that, I think. Yeah. So maybe, I also expected them to do it. It hasn't happened yet, though. You never know.
I'm always waiting to see, but yeah, when it happens, they'll do it big style.
They certainly will. Yeah. They certainly will. I sat a few years ago in a conference in China in front of 300 Forex executives, Chinese Forex executives, most of which they were sort of introducing brokers to a large extent, but their companies were bigger than a lot of brokers.
Yes.
Because they have 4 screens, they have dealing desks, they have huge amounts of customers. Some of them are doing 100,000 lots a month. Yes. They're very quiet in small parts of China, and they all understood that will happen at some point. Yeah. But they're just biding their time until it does. Yeah. So yes, it's a powerhouse waiting to be unleashed, I think.
Yeah, I think so.
So very interesting indeed. And I think we've got to keep doing our bit in the industry to keep innovating and making sure that our access to liquidity is still something which serves clients' ever increasing astuteness and need to diversify their pools of liquidity.
Yeah, I just, as we finish, I remember when I was new in this world, in technology, being asked by a CEO at a company I worked for, he said, so when will the technology be finished?
Right.
He said, when can I get rid of all the software developers? I said, no, you
never
don't get this.
Never. That's right.
It will grow and grow and grow.
Will.
It'll never be finished. Just because he came from a different era, he didn't really get that. He said, what do you mean it'll never be finished? A car is designed and built and then it's finished. They move on to the next one. Software is not like that.
It's not like that,
It
no.
never, ever finishes.
Like
and I think that was a bit of a shock to
In fact, it's going to go the other way. You'll need more and more developers because the development period is shorter and shorter and shorter now. Yes. Because there's no hardware dependency, especially now. The ability to change things is much quicker. You don't have to think, we've spent millions on hardware, so we have to have an 8-year development cycle. Can you imagine that? 8 years? And it'd be impossible. 3 months, 6 months, everything it keeps evolving.
Well, I was talking to a friend of mine who runs a large American company that develops retail stock trading systems, and they said they have twice a day they issue a build of their platform to their clients.
Really, that's incredible.
Twice a day.
That's incredible.
The software is built lunchtime and in the evening.
Wow.
It goes through full automated testing.
Wow,
everything is automated testing and released. Twice a day.
Can you imagine the UAT testing, the pre-production testing, all done in half a day?
It's fully automated.
That's incredible.
Fully automated, so no humans have to touch
it.
Isn't that amazing?
That is incredible.
So they can innovate so quickly.
Yes.
Just incredible.
Wow. You think 3 months is quick?
I know.
Half a day? That's incredible.
It's amazing, isn't it?
Half a day for a market-dependent piece of software.
And
incredible.
It works. It doesn't break.
That's amazing.
They have a very reliable system. So I was seriously impressed.
Chicago?
New York, actually.
New York
right.
system.
Yeah, I was
Interesting.
very impressed.
Well, there you go. We've got a lot to live up to there.
I think we have.
Nice to see you again, Tom, and thanks very much for joining me.
Well, thanks very much for inviting me.
All the best.
Thanks. Bye-bye.